Welcome to AHA Math and Science. In today's video, we're going to be discussing the wild swing in the Treasury yield and the associated market volatility. So a few weeks ago, I did this video about the yield curve, and specifically, I point out that the de-inverting and the inverting of the yield curve can be used as a good predictor for recession. In fact, the yield curve always kind of de-inverts before each recession. So shown here is the 10-year Treasury and the 2-year Treasury spread. So the yield spread between these two Treasuries. So in the normal times, the 2-year Treasury yield is greater than the 10-year Treasury yield is greater than the 2-year Treasury yield. So the yield curve is kind of positive. Before a recession starts, usually the yield curve kind of inverts, meaning that the 10-year Treasury yield is now smaller than the 2-year Treasury yield. However, just before the recession starts, you can see this inverting start to kind of shrink or become less inverted, and that's basically de-inverting, and that always kind of happens right before the recession. And this kind of de-inverting is true basically for before every recession since the early 1980s. You can see the yield curve here kind of de-inverts. And so very inverted, almost like -2%, which is the inverting, the level inverted between the 10-year and the 2-year Treasury yield. And then de-inverts just before the recession. And then again, it did so just before the 1982 recession, before the 1991 recession, and also happened during the basically the recession following the burst of the dot-com bubble. That's in 2000. And then also it happened during the great financial crisis. You can see here, it inverted and then started de-invert just before the recession starts. And even during the recession following the pandemic, you can see that the yield curve just kind of dipped below zero, the yield spread. So a small amount of inverting, if you look closely, and then start kind of de-invert. Now, what about the current case? The current case, you can see that the yield curve is very inverted. It's reaching like about -1%. So similar to the level that we have seen in the early 1980s. So then it seems to start to narrow down the amount of inverting. So that's de-inverting. Now, in addition to this inverting and de-inverting of the yield curve, we also see that the kind of the volatility in the yield curve. So you can see that all these up and downs that happens very rapidly, that's volatility. And so it happened in the early 1980s, and it seems it's happening now also. You can see the yield spread goes down and then sharply reverses. So this is volatility. And we can take a close look at what's going on in the present time. So this is the same curve, the 10-year and the 2-year Treasury yield spread over the past 5 years. You can see the yield curve inverted in the middle of 2022, and then reached a level of -1% or -100 basis points. That's basically kind of like a highest since early 1980s. And then just last month, in the middle of a banking crisis, you can see that the inverting started kind of de-invert. So in other words, the spreads kind of like shrink and become less negative. And then in the last few days, there's still a lot of swings going on. So the fact that it goes down and sharply reverses and then just kind of swings back and forth is really volatility. So in the yield spread, we see the volatility. And the underlying sort of cause of this volatility is just the volatility in the 2-year Treasury yield. So we can take a look at the 2-year Treasury yield. And you can see here that just kind of at the beginning of this year, 2023, everybody's kind of excited about a very resilient labor market, but at the same time we are seeing that the inflation stays high. So there's a lot of kind of pricing in of a high interest rates down the road. That caused the 2-year Treasury yield to go up and even kind of went above 5%. But then something happened during March. Basically, following the collapse of the Silicon Valley Bank, we have a banking crisis. And then the yield just kind of plunged. not just the 2-year yield, but also the 10-year yield. All the sort of the Treasury yields just kind of plunged amid this banking crisis. And then in the last few days, you can see that it's still kind of very volatile. It swings on a daily basis. So this kind of volatility, when the yields just kind of like swings from 5% to less than 4% in a matter of few days, is kind of like really signifies something is going on in the bond market. So strong volatility. And that kind of volatility was lasting during the great financial crisis in 2008. So this become much clearer when we look at the Bank of America MOVE Index. So what's the MOVE Index? It's a close watch proxy of expected Treasury swings. So you can see that the Treasury yield volatility kind of spiked in 2008. Now it seems that we are spiking again. In fact, yesterday's headline news says trading volatility is the new reality for bond investors. It points out that a gauge of U.S. rates volatility reached the highest since 2008. Indeed, you can see that the level of volatility here is comparable to what we have seen during the great financial crisis in 2008. So it's now the highest level we have seen in this cycle is 180. And obviously, in the great financial crisis, we have seen that volatility even reach more than 250. So what does this mean, this volatility in the Treasury yield? What can this be used as a sort of indicator to predict the volatility ahead for the market? So now let's take a close look at these two things. So by plotting the MOVE Index together with SP 500, which is scaled by a factor of 100, and plotted on our scale, we see this correspondence very clearly in this chart. So first, look at the MOVE Index. You can see that during the financial crisis in 2008, it bottomed at a level of 51, meaning that here, there's not a lot of volatility in the bond market. And then it kind of increased and it topped at a level 265 in the height of the great financial crisis. And during this increase of the MOVE Index, you can clearly see there are 3 stages. There's an initial increase, then there's a drop, then a very rapid increase as the final phase. But during these 2 initial sort of increase and a drop, you can see the broad market kind of decreased and then entered this consolidation phase. And note that even here, the market is already in a bear market, but the drop is still just like something around 25%. And in the third phase, when the MOVE Index kind of spiked, meaning that there's a lot of volatility, the volatility in the Treasury yield just kind of picked up. So the Treasury yields can just kind of swing a lot. And then you can see correspondingly, there's a very quick and ugly drop in the SP 500, the broad market. So that is really something we're watching. So in fact, the market did not bottom, or the bear market did not really end quite some time after the MOVE Index has peaked. So what about the current case? This is what we're interested in. You can see here that the MOVE Index kind of bottom around, kind of stays around this low level of 51 in most of the time of 2021. And then since the end of 2021, early 2022, the MOVE Index started kind of increase. And then also it dropped somewhat early this year in January and February 2023. And during these 2 initial phases, we see the broad market decrease, enter into this bear market. And then in the last few months, it's just kind of in this consolidation phase. So that's what's going on in these 2, the initial stage, which is very similar to what we're seeing in the 2008 great financial crisis. Now we seems to be in this third phase when the MOVE Index can pick up following the banking crisis. And we think it's not done yet. There will be further room to go because first, the Treasury and the Federal Reserve just kind of applied a temporary fix, a band-aid, try to fix the banking crisis. But the underlying problems are still there. Yeah, they are not being resolved yet. Second, you can see that the MOVE Index undershoot a lot because of the low interest rates following the pandemic. So we suspect that it may take some overshooting and to really for the interest rates to be normalized. We are talking about this normalization process. and it will not really kind of happen without some volatility in the Treasury market. So this says there probably will be further room to go for the MOVE index. And correspondingly, we suspect if history is any guide, as the MOVE index kind of sharply increases, and usually it is kind of accompanied by a quick, ugly drop in the bull market in the SP 500. And also, the market really kind of did not bottom until the MOVE index peaked. After actually sometime after the MOVE index peak, then the market will bottom. So this is really kind of important information. So the kind of recap what we said in this video is one is basically we suspect that a quick ugly drop for the bull market, it could be imminent as we are kind of entering into the third phase of the swing or the volatility in the Treasury market. The bond yields are really kind of non-stable. And also the second message is basically the market did not bottom until sometime after the MOVE index has peaked. So we're going to watch the MOVE index peak first, then we can see that we can talk about bottoming of this bear market. So I hope you have enjoyed this video and found the information presented here interesting. As always, your support really kind of means a lot. So please do not forget to click the like button and also subscribe to our channel so that you can watch more videos like this one. And thank you for watching.